Hello, everyone, and welcome to Spotlight On with Innovate Finance, a monthly series designed to showcase some of our innovative fintech members and explore the trends shaping the future of financial services. I am Joshita Ganesan from Innovate Finance, and today we're discussing infrastructure as a competitive advantage. I'm delighted to be joined by two founders who are building the next generation of financial infrastructure. Ojerinola, founder and CEO of NOBO. NOBO is building digital trade finance infrastructure that helps export SMEs become more visible, verifiable, and bankable. Its platform combines AI-powered credit assessment, digital trade documentation, and streamlined compliance to simplify access to cross-border trade finance and connect businesses with funding more efficiently. Thank you, Ayo, for joining us today.
Thanks for having us, Joshita. It's great to be here.
Great. We're also joined by Luca Ambrosio, founder and co-CEO of Platform D. Platform D is building an end-to-end on-chain capital markets infrastructure for the digital securitization of real-world assets. Currently testing within the UK's digital security sandbox, the platform transforms investment-grade trade finance receivables into tokenized securities, enabling transparent, programmable, and capital-efficient access to institutional-grade yield while bridging traditional finance and digital asset markets. Thank you, Luca, for joining us as well.
Great to be here. Thank you.
Amazing. Great. So do you also want to quickly talk a little bit about yourselves, your background as well? Should we start with Ayo?
Sure, thanks. So my name's Ojerinola. Thanks for that great introduction. Background-wise, I've spent 20 years in my career building payment systems with the likes of IBM and clearing and settlement mechanism systems with MasterCard. I became an avid fan of blockchain technology in about 2016. And very quickly understood that the future of financial services would be moving on chain. So since then, 2023, embarked on this journey with NOBO, initially to help to bring the future of financial services to the common person, helping them understand Web3 and helping to make that paradigm shift frictionless for businesses and individuals alike. And where we've landed with that is NOBO now being a digital trade finance platform optimized to help SMEs in the world of trade finance by making them more bankable, verifiable, and visible. So NOBO is essentially the trust, financing, and settlement layer for SMEs in trade.
Thank you, Ayo. Luca, do you want to go next?
Yes, thank you. Thank you for the introduction, Joshita. My background is finance. I spent 20 years on markets and financial markets, trading on the risk-taking side. I was with Goldman and More Capital, and I set up my hedge fund back in 1999, and that was the first global macro fund fully regulated in UK. I turned towards decentralized networks in 2018 and never looked back to centralized finance. We are building at Platform D since 2021. As you said, Joshita, we are building a on-chain securitization capital market engine that is capable of originating, issuing, settling, and maintaining digital assets on-chain. So we differ from the typical tokenization process because we do generate the asset on-chain. And this is thank you to the new financial market infrastructure that is we have been testing within the digital sandbox in the UK, which is called the Digital Security Depository. It's a digital central security depository, which allows it to issue directly on-chain. So we have been embarking in this project just because we are really focused on one particular utility that we would just want to offer exactly to the same clients that IO is covering, SMEs, we are obsessed by compressing basically the cost of trust. And so to increase credit transmissions from investors directly to SMEs. So that is why we are disintermediating capital markets on chain. And we can do it using a lot of digital identity, but we will talking about that later.
Thank you, Gianluca. Very interesting backgrounds, both of you. And to kick off our sort of conversation, actually, we always talk about the landscape and the landscape in 2026. So, Gianluca, I'm going to start with you. So what are the top infrastructure shifts giving firms actually an edge in digital securities and capital markets right now?
Well, the foundational shift has been the recognition of real-time near zero cost notarization utility that is offered by blockchain, by public blockchains, or public consensus, I would say. This has been really the big shift that has made possible, of course, a number of applications. But what is important is that on that foundational shift, other technologies have come, and we know smart contracts, digital identity in selected disclosure, so privacy protecting, and AI is now kicking in quite strongly. So with this 3 or 4 combined technologies, we can now provide on-chain or let's say trust on a scalable basis and compliant basis. We have been focusing on digital identity, to apply digital identity both to users and assets, users when they interact with the applications, and also even validators which are interacting with our public blockchain, D-chain, and the users when they interact for transacting with the application on chain. So that has been the ingredient that has pushed us to say on-chain in decentralized finance in general, but on-chain finance can become compliant. So this has been for us the major shift, and we think building on that, both native and incumbents will create a proper, efficient and convenient financial services.
Thank you. That's very interesting to see all the shifts that you had highlighted. And I'm going to go next to Ayo. How is the new infrastructure, like we have blockchain, open banking, stablecoins, CBDC, all of these enabling capabilities that weren't possible before?
There is so much to unpack with that. I think we really are seeing a paradigm shift in financial services as a result of the amazing new technologies that are here now. Not even on the horizon, they're actually delivering impact already. And I think between open banking, open finance, and blockchain specifically, so we're now talking about the multi-moneyverse, which could potentially all be built on blockchain. So we have new forms of money, and those new forms of money come with programmable payments. Okay, so just being able to programmably execute payment instructions based on conditions, milestones, using smart contracts, that is very powerful. And there is a lot of efficiency gains that come with that. There's a lot of speed and reduced cost overhead that come with that. And open finance, open banking, I think is just amazing. a lot of push to get that to mainstream adoption, and I think it's coming to fruition. And I think it pairs itself quite well with blockchain technology. So from the open finance, open banking perspective, there have been a few studies conducted over the last few years by organizations like CFIT, with great conclusions and demonstrations coming out of that. And I think those are now going to start coming to market. So we're talking about SMEs here. CFIT did a study on how to improve SME access to financing with great results that showed you could have a 25% uptick in acceptance rates for SME financing, which is great. And more recently, I think CFIT also did a study around digital identities. And so the whole conversation around digital identities and verified credentials, two things that A, can pull from open finance to help with verification and the insights from open banking, but B, can issue identities on blockchain technology. These are things that we weren't able to do in this way previously, but the technology is here now. The studies have been conducted, and the market actually wants this. And platforms like ours are incorporating this into what we're building, so we can deliver this value to the SMEs and to the industry participants to help remove a lot of the friction and a lot of the overhead costs and a lot of inefficiencies that currently exist in financial services.
Thank you, Yo, for the brilliant statistics around that as well. Very, very interesting to see. And now that we've talked a little bit about the landscape, I think we should dive more deep into the actual infrastructure. So let's go into a segment where we talk about where infrastructure breaks or wins. And I'm going to start with you, Ayo. Where do firms lose value operationally in cross-border payments, trade finance, or compliance?
Sure. Cross-border payments. This is a big big piece of my background, where I did a lot of work in payment engines and infrastructure for payment solutions. And cross-border payments has been a difficult space. Until more recently, where stablecoins are really flying as a result of their ability to help bridge cross-border payments and cut out a lot of the friction and overhead costs in the middle of that. So correspondent banking is dated. It's historically been quite expensive. You look at emerging markets, Africa in particular is one of the most expensive places in the world to move money across borders, in and out of Africa and intra-Africa. No surprise that Africa is now a huge adopter of stablecoin. World's second largest adopter of stablecoin is in Africa. Same in Latin, South America, we're seeing the same sort of shifts because cross-border payments has been such a difficult space inherently. So firms have been losing in that space in terms of the costs for transacting across borders, but more so in treasury management, which also has some element of cross-border, where firms invested in foreign markets can sometimes see some of their profits wiped out overnight, depending on what happens with the local currencies and volatility of those currencies, or perhaps some sort of fiscal policy or financial policy shifts that meant that the current local currency got devalued overnight. So cross-border and treasury management is a big space that I think there's a statistic about 2 trillion is spent annually on trying to resolve treasury management issues globally.
Wow.
There's a similar amount of money locked in foreign markets just to provide liquidity to help to absorb some of these issues. So there's a lot of capital being spent fighting cross-border and treasury management issues currently. So that's a huge space where there's a lot of loss for firms. Trade finance is a huge market. A lot of challenges there. Again, complements with the challenges in cross-border payments, but I think trade finance's biggest problem is also with compliance. So this is a great question because all three things sort of tie into each other quite nicely.
Yeah.
Trade finance, I think fraud and compliance. So and fraud and compliance also tie in. So how do you mitigate fraud? How do you mitigate risk? And how do you do that in an affordable fashion? So we were in the Digital Pound Lab at the Bank of England last year, where we did some work around trade finance, helping to exercise the future digital pound in trade finance scenarios. And we dug into a lot of this. And we were digging in specifically looking at the challenges that SMEs had and why they were having issues in the world of trade finance, getting access to finance. SMEs have a 41% rejection rate for trade finance, according to the Asian Development Bank. And there's a $2.5 trillion trade finance gap globally. And what we found was, apart from the obvious issue of SMEs having a thinner profile and a smaller footprint than say a multinational, we found that some of the reasons SMEs were having a hard time getting access to finance is because the smaller the deal, the less economically viable that deal becomes. And that is primarily due to the high cost of compliance and due diligence. So compliance is another space where firms lose because it's a lot harder to complete due diligence and compliance on a firm in a foreign market, even more so with an SME with a smaller footprint. And then at some point, you have to weigh up the cost of actually doing that verification, that compliance, that due diligence against the margins that you can make on the deal. And naturally, an SME deal is going to be smaller than a big multinationals deal. So if you're looking at a $50 million deal with an oil and gas company and the overhead cost of compliance and due diligence is $15,000 to $50,000, you might not mind. But if you were looking at a $500K deal for an SME or a $100K deal for an SME, all of a sudden a $15,000 or $50,000 overhead cost is very significant, and just means that deal is not economically viable. So the cost of compliance and due diligence doesn't change depending on the size of the SME or the size of the business, but the size of the ticket changes depending on the size of the business. So yeah, definitely a lot of challenges, and the existing overhead costs, the existing processes, the existing infrastructure just doesn't lend itself well for cross-border payments into emerging markets, for SMEs in trade finance, and for compliance for smaller ticket deals.
Thank you for touching on all the three components in that one question. I thought that was very insightful. Now I'm going to come to you, Gianluca, actually. So in terms of now that we've talked about Oyo's thoughts on those, in digital securities, I'm going to ask you, what's the hardest? Is it the data standards, regulatory integration, or the legacy systems?
Well, first of all, thank you very much, Ayo, because you basically did the marketing speech for us. We are securitizing on-chain electronic invoices. So what is different for us is that we are focusing enormously on the origination. So the compliance by attaching identity to the asset and to the users, we are basically performing what the Bank of England is calling real-time compliance. So that is a solution, but we are helped by the fact that the invoice itself it's already digitally signed in an electronic form. And now this is expanding across countries. But that is really where we are responding to all those questions that you were mentioning, because we are extensively using digital transformation tools. And so for onboarding, and we are combining with digital identity. But to answer your question, Joshita, in our experience, that hasn't been the hardest element. All three are really playing a role. And data standards, of course, because we are native in the public blockchain we built and the applications, we are native also in the financial market infrastructure that we are building on top. Data standards for blockchain has been from the beginning. So interoperability, an obstacle, and standards in digital identity have been an obstacle for a number of years. Now everything is converging towards accepted standards, or the most accepted standards, and so everything is becoming, especially for those who are entry at the space at the moment, is becoming relatively easier to adapt. But data have been and definitely an obstacle. The regulatory integration notably has been an obstacle for DeFi, because DeFi was prioritizing, of course, a trustless interaction. And when DeFi was looking to scale, well, it realized that scale cannot be achieved without compliance. And now the problem became a broader problem for the broader industry, both the native players and the new entrants, or the even incumbents, because everybody was looking for the rules, was looking for the guidelines, and now we are getting rules and guidelines across the different jurisdictions. So it's better to strategize on what is going to be a sustainable compliance system, adaptable to decentralized networks and applications. And last but not least, the legacy systems for incumbents have been a major struggle. But this is very legitimate struggle, because there's no one senior decision maker in any of the incumbents or the established firms or players that is underestimating the economic cost and the political cost to change basically everything, because you go from a centralized system and networks to a decentralized one. So you change IT operations, legal and compliance, marketing, sales, you name it, everything has to change. So that has been, of course, a major problem. It continues to be a major problem. We are lucky in this sense that we started from scratch. So we had an open mind on waiting and resisting to a number of technologies that we thought were limiting the value creation of public consensus. And so we are now well positioned to leverage on what the different both players and regulators or legislators are recognizing to be the proper value of blockchain.
It's very insightful to see all the sort of struggles that you're outlined. I'm sure a lot of other fintech founders could probably resonate with some of the points that you mentioned. Thank you for that. And now, of course, the both of you have now mentioned AI actually, but now we're going to talk a little bit more deep about AI automation, and with that comes trust. So I'm actually going to look at you, Gianluca, again. So how do you think AI can improve digital instruments and capital markets infrastructure while scaling trust and interoperability?
Yeah, it's still a discovery type of effort, to be honest. We are internally, of course, using extensively AI to speed up our proprietary coding, for example, or to optimize our internal intelligence, to strategize. But what really excites us is the use of agentic AI to the help of users. And here in particular, there is one element that we, as I said, I repeated many times already, it's really characterizing our technology. It's a digital identity, and particularly is how people and companies and businesses will be able to collect, store, and maintain their credentials, their verifiable credentials. And this will, in our opinion, open to a very different financial markets and financial services in general. Different because by helping the users to collect their credentials, what the European and UK regulation calls electronic attestation of attributes, it will allow the user to interact with Web3 applications by presenting and spending their attributes in selected disclosure. That will increase the trust, but not only the quality of the trust, but also the confidence and assurance that the regulators need to eventually lower the level of assurance needed to interact with certain applications and certain services. Not only in finance, but also when people and companies and businesses are interacting socially. This is really very much for us the turning point for social and financial inclusion. If I'm able to spend my verifiable credential in real time, so I can comply in real time with whatever is the service that is offered, that will help me or incentivize me to collect and to maintain my credentials. This is where AI can play a big role, because agents can help to maintain, to collect, to improve the quality and the richness of the credentials over time. So this for us is it's very exciting.
Yeah, it is very exciting indeed to see what capabilities AI can offer. So you've outlined that as well. So thank you. And can I also bring you in, Oyo, next, actually? I know you touched on fraud detection and compliance a little bit earlier, but how can AI improve operational flows like fraud detection, settlement, and compliance? And what infrastructure do you think is needed for trust and auditability?
Great question. And first of all, just right back at you, Gianluca. So many similarities between the issues that we're tackling. I think Joshita has done her homework really well.
We just need to connect.
Yeah, we're probably going to have to jump on a call after this. Yeah.
Perfect. My job is done now.
Yes. And you touched on a few important points there on digital identities, verified credentials, but more importantly, selective disclosure, where I think that trust from the user perspective comes because they know that they own their data and they can decide who they share that data with or how much of that data they share. And I think Web3 was really designed with that construct in mind, where the user owns their own identity and they can, it's decentralized by nature, right? And I think, I was doing a presentation at BCS on Friday, and someone asked what I thought about the government canceling plans on national IDs. And people weren't fond of that plan because they wouldn't necessarily own that data and have that selective disclosure. So I think all the momentum's moving in this direction for people being able to own their data and have selective disclosure. More importantly, with AI, agentic AI, agentic payments are going to be here. We're going to have agents doing their own thing, and those agents will also need to be able to identify themselves, or at least identify on behalf of their owner, which again, we would need these sort of digital IDs that are programmable and with selective disclosure to exist. But in answer for your questions, I think, AI is already doing a lot in this space and very much so needed. Operational flows, fraud detection, agentic you mentioned, just for scalability. There's a lot of fraud, and fraudulent actors are very intelligent and very creative. And there's so many vectors they can attack. It's really expensive, cumbersome, difficult. You need a big team with high overheads just to be able to keep up with fraudsters and fraudulent behavior. And agentic agents and AI go some way to reducing that overhead cost and resource that's required, and increasing the speed of being able to detect fraud even before it happens. So AI is super important in that space. I think there's a firm called Comply Data that already have some products in the trade finance space around detecting fraudulent documentation, for instance, which is a big issue in the world of trade finance. With settlement, we just talked about agentic agents and agentic payments. So again, you have speed, you have micro payments, you have all those efficiencies that can come with AI managing the settlement layer, managing the actual microtransactions that you don't really need a human sitting there and going through the friction to make a payment. And you don't really want B2C with too much friction in terms of approving settlement, but also executing on the settlement as well. So AI can play a big role in that. And there's so many other layers that come with settlement where AI can also help with the compliance, the fraud detection, not just the execution. But specifically compliance, I think there's a couple of great firms that I'm aware of, I've come across that are doing great things in this space, like Recomply AI, who can actually ingest your existing operational workflows and give that to their platform, which has agentic agents that translate that into agent prompts. And so they can execute and manage your entire workflow for you, which of course increases your speed, reduces your overhead costs, and removes a lot of the friction. We've also got a Comply Stream, which is another great company in this space, doing a lot with automating back-end office actions to help your compliance team, help reduce your compliance overhead. And I've been hearing about numerous firms that have so many challenges with keeping up with their compliance requirements that they just lose business, and they just don't take on extra business because they just can't deal with the existing compliance requirements and overhead. So AI is going to come into this space in a big way and really help to streamline everything from fraud detection to settlement to compliance. And that will remove this bottleneck that currently exists and help operators to be more efficient in this space, and hopefully help us to take more business on board, which leads to more growth.
Thank you for the very deep answer. So now that you've both touched a little on scaling infrastructure as well, I think it would be really valuable to talk about scaling infrastructure globally. So for the both of you, is competitive advantage about owning infrastructure or orchestrating best-in-class services? What do you think? Who wants to take this?
I'm happy to take that.
Yeah.
We're a bit of a hybrid at NOBO. Of course, it's great to own the infrastructure. The way I look at it, you can reinvent the wheel, or you can use what's existing. So using what's existing is orchestration. But if you're fully orchestrating, you don't own any of the infrastructure, there's a cost for that. It's great you can have your IP as an orchestration layer, but you have to always partner with the infrastructure layer. And then you're almost beholden to what the infrastructure layer is doing and what their SLAs are and those partnerships. But also, similarly, if you're purely an infrastructure, you own the infrastructure, you don't have to pay anyone for that, but you're also then perhaps limited in the applications you can pursue. Your focus is the infrastructure for whatever it is you're supporting, and that's it. You get a lot of infrastructure providers that maybe try and delve into offering other services, but that's never going to be a scalable in your pure business. You have to focus on your core business, which is then the infrastructure. So I like the hybrid approach, and I think that's where you can really win, where the infrastructure that's not existing that you need to be able to innovate in your space, to add value and to be competitive, you can build that. And the infrastructure that you don't need to build, it's already there, it already exists, it's already best in class. You don't need to reinvent the wheel, you don't need to try and compete with those providers. Then you can collaborate with them and you can orchestrate that integration. So that's the approach we're taking, and I think that's a good approach.
It's a long running debate where the value sits. Has been debated for a long period of time. It sits at the base layer or at the application level. It's a bit like that. Translated in business words. Now we decided 5 years ago that the question wasn't really where to capture the value or the advantage, but the question for us was very much to have a base layer that could provide us with qualified consensus. And when we say qualified consensus, means that the validators that are validating the blocks on the public blockchain we're using underneath and we built, they have to credentialize themselves to be able to validate the blocks. And so we can add credentials according to what we think is making the layer one sustainable over time. But more than that, the layer one needs to be able to host regulated applications and FMIs. And we are one of them with Platform D. So we decided to build both, basically. And certainly to be hybrid, as I was saying, towards all the other infrastructure we need, because we are end-to-end. So we need payment infrastructures that we're not building. We need custodial infrastructures that we're not building, et cetera, et cetera. But the two main things that we wanted to have, just because we didn't want to end up by having too many dependencies on the consensus layer, and this is to our let's say satisfaction. We now see that there are many of the on-chain fintechs that are building their own public blockchain. So you have Arc, Tempo, you have a layer 2 of Robinhood. So why? Because they found that to scale and to be able to obtain that capacity or to retain that capacity in the future, that is qualified capacity, they need to have a layer 1 that I wouldn't say control, because it has to be decentralized and public, but to rely on and to eventually add all the those functional applications that are improving their main service they are providing. So we decided to basically build both.
Okay, that is very interesting to hear from the both of you. Now that we've talked about, sort of scaling globally, let's also take a look at the ecosystem. So how important is ecosystem collaboration between platforms, financial institutions, and regulators, especially in the space that you're currently operating in? And how do you see that, being useful for your businesses as well?
Well, what we think is, and this reminds me the early days on the hedge fund business. This is an industry, this is a very young industry. It's an industry where we're still building new applications, new primitives, and where regulators are adding guidelines, rules by the week now. So we don't consider, to be honest, those who are building or running businesses or utilities that are similar to us as competitors. We think that at this level of initial institutional participation and adoption, partnership, integration, collaboration with all the stakeholders, it's key to scalability and adoption. So we are really very much open, and we've been open to speak with natives, which our technology is Cosmos-based, so it's very native, to incumbents, to regulators, legislators everywhere. I think it's crucial for the industry to take off. And I experienced the same in the hedge fund business back in the late 90s, where the only few established hedge funds were talking to each other, even if they were running the same strategies.
Yeah, no, that's great. I completely agree. And two things I want to touch on. I think the regulators part of the question is almost in a separate conversation on its own, because it's so important. And everything starts from the top down, right? And then down to the collaboration of the industry participants. So, I spent the best part of the last 2 years understanding we were building a digital trade finance platform. We were going to be in this sort of gray space with Web3, stable coins, CBDCs, tokenized deposits, where the regulation hadn't quite clearly been defined and landed, and there was a lot of hesitation for established institutions to enter the space fully, and a lot of gray area where firms that were operating at risk, really, because they weren't really clear on where the regulation was going to land. So I actually spent a lot of time with Innovate Finance and with the Payments Association in working groups to engage with regulators to ensure that the industry's voice was heard by the regulators, and that the coming regulation was going to be give the UK in particular the best possible chance of succeeding in this transition into a more Web3 focused financial services space. So things like stablecoins, CBDCs, tokenized deposits landing in the right way. So that's super important to have that communication, and I was really pleased that organizations like Innovate Finance were leading in that regard, and that the regulators, the Bank of England, everybody was open to listen to the industry and to ensure that they created the right atmosphere for businesses to thrive in this space in the UK. And then, once you're done with the regulation, then it's down to how does the industry participate or play with each other. And a word I really like, and I think that's is super important and is sometimes overlooked, is interoperability. This problem has been around from the previous generation of financial changes, and I think if people don't pay as much or more attention to it this time around, we'll end up in the same place. So super important for everyone to talk about this and to interact with each other and understand that whatever we do, we need to have one eye on interoperability and bake that into the wider ecosystem to ensure that, okay, everybody you can have your different approach, you can have your different ideas, but let's ensure that we don't put up too many barriers and too much friction, and we don't do too much in silo where everybody ends up in closed loop systems again, and it's very difficult to have the freedom of data moving and value moving across platforms. So yeah, let's continue to talk. It's super important, and I think primarily for those two reasons: one, making sure that the regulatory order of the day is conducive for the players, and also make sure that the players can actually interact and share information with each other, so their platforms are interoperable.
Thank you, Oyo, for giving a very good outlook and also for your very kind words and for the shout out. So thank you for that. Now, I think we're nearly, reaching the end of this conversation. So whenever we discuss topics on this podcast, we also talk about the future. So I'm going to ask you both a very future-looking, forward-looking question. So in 5 to 10 years, what do you think will define infrastructure-led advantage?
We think in 5 to 10 years, probably earlier, both payments and capital markets will be dominated by on-chain fintechs. And when I say on-chain fintechs, it means that basically every financial service will have to transform into fintech. So on-chain, as we're doing a digital security depository, so where the securities are settled and maintained and stored will be on-chain, on-chain banks. So the whole market, the whole financial services will be dominated by those who can have two things. They have very good applications so that interacting with users, of course, through wallets, will need to be a very, very good experience for the users. And they have capacity on the infrastructure. So the capacity of infrastructure is either because they acquire capacity on the infrastructure, or the gain through certain technology capacity, or they have their own infrastructure that they built. So this is crucial. And when we were discussing several years ago with the regulators, what is the future of CBDC? What is the future of private blockchains? We said many, many times, these are kind of tentative optimization of existing technology that won't be sustainable in the way we are imagining the future of financial services. Basically, central banks need to transform into a fintech company to run a properly open, interoperable CBDC. Is that plausible? Maybe not. So these are the things that we are expecting. We're expecting efficient applications, efficient infrastructure, and I would say a number of leading on-chain fintechs really providing those services at a very efficient and convenient terms.
Yeah, I agree with a lot of that. I think from an infrastructure perspective, that the name of the game will be efficiency. Who has the best speeds, who has the highest capacity, who has the best security, and I think the winners in with those metrics will sort of become the de facto rails. I think the UX will probably, from a human user perspective, will probably disappear in 10 years, where we'll all just be using agentic agents to do what we need, which means, again, speed and throughput and costs will be key factors. The AIs will be able to determine, okay, this is the most efficient rail, so I'm going to use that rail. And the human just doesn't even have to think about things like that anymore. You don't have to think, oh, I want to go here, I want to go there. Don't really care much about branding anymore because your AI is just doing all that for you. So I think that will be infrastructure led for sure. So the most performance infrastructure providers will get that business. In terms of the utility, I think on the CBDC point, I slightly disagree. I mean, maybe make the distinction between CBDCs as wholesale or retail. The only reason I disagree is because if we do imagine financial services world moving on chain, and central banks not having representation in that, then what happens to central banks? I don't see central banks disappearing in 10 years. So I'm pretty sure central banks will have some representation in that future, and probably should, because there's always the issue and the topic of sovereignty, right? If you don't have a national representative in that space, then who's in charge of your monetary policy? Who's in charge of your monetary sovereignty? And we can say it's decentralized and it's trustless, but yes, in the deep future, but maybe not in 10 years is the point I'm making. So very interesting times, and I'm super interested to see where this lands in the end. But I think in the next 5-10 years, central bank will still want to play a role in this, as will banks and as will private issuers. So yeah, very, very interesting times indeed.
Great. Thank you for those very interesting opinion and insights. And thank you both for sharing your insights today. I thought it was a really interesting conversation, especially on the topic, very timely. So thank you, listeners, for tuning in. That's it for this episode. We'll be back with another one very soon. So thank you, Gianluca. Thank you, Oyo, for joining us today.